Good afternoon, everyone. I'm Aisyah from Investment in Fintech application class. Today, I would like to explain to you the research based on Kent D. Miller and Zur Safira research. The title is An Empirical Test of Heuristics and Biases Affecting Real Option Valuation. Okay. Investment decisions managers face under uncertainty that can be characterized as real option problems. The researchers in these fields nowadays are actively develop normative techniques for framing and evaluating real option investment problems. Also, there are a few researchers did research on the behavioral aspects and managing real options before, such as Howell and Jagel. In 1997, they said managers' assessment of real option deviate from normative models. Meanwhile, Busby and Spitz in 1997 said organizations lack systematic approaches for assessing real options. And Graham and Harvey in 2001 said managers apply real option analysis in only a small minority of their capital investment decision. Those facts alert us to the potential for biases in the more complex context of the option identification, valuation, and exercise decisions. So, this research by Kent D. Miller and Zur Safira contributes theoretical propositions and empirical evidence regarding managers' subjective perception of call and put options values. Now we jump into the theory they use in this research. The first one is option theory basics. There are two types of the options called calls and puts. A call option provides possibility, not the obligation, to purchase a particular asset at a given price, known as the exercise or strike price. A put option confers the prerogative to its holders to sell an asset at a specific exercise price. The option price means the value of the option at the time of exchange between buyers and sellers. Option holders will exercise the option when the price of the underlying asset exceeds the exercise price only. Meanwhile, the put options will be exercised if the asset price falls below the exercise price. Now, risk preferences and option pricing theory. Risky choices involve probabilistic outcomes. Individual decision makers' attitude towards risk could be described in terms of the parameters of their utility functions. When faced with a choice between a sure outcome and a risky alternative with the same expected value, a risk-averse individual will choose the sure outcome, of course. Levy and Sarnat in 1984 already did study for 25 years of investment in mutual funds and observed that investors were averse to the variance of returns. Meanwhile, Kahneman and Tversky observed that when dealing with risky alternatives with gains as the possible outcomes, people appear to be risk-averse by reduce the variability of outcomes. But if they are dealing with a risky alternatives with possible loss outcomes, people tend to be risk-seeking with increased the variability of outcomes. So in this study, there are four distinct cases to consider. There are purchasing a call, selling a call, purchasing a put, and selling a put. With assumptions, the call option buyer and put seller have no pre-existing risk exposures. Meanwhile, the call seller and put buyer have pre-existing exposures they seek to hedge. Now about the purchasing a call option will be exercised if there are in the money. So the possible outcomes for their holders are either gains or zero. And the hypothesis for this purchasers price call options at discounts relative to their expected payoffs. Selling a call, a risk-averse option seller would be willing to discount this price. Seller is still exposed to the possible loss if it's possible, and the hypothesis for this uh, theory is sellers price call options at discounts relative to their expected payoffs. Purchasing a put. A risk-neutral individual would be willing to pay up to the absolute value of the expected loss for the put option, but a risk seeker who would actually prefer to hold the risky asset would offer to pay a price discounted relative to the absolute value of the expected loss. So for hypothesis is purchasers price put options at this discount relative to their expected payoffs. Now selling a put. Put option sellers have no pre-existing exposure. Rather, they make discretionary choices to take unavoidable potential losses. So the hypothesis is sellers price put options at a discount relative to their expected losses. Now about the time preferences and option pricing theory. Benzian, Rappaport, and Yagel in 1989 mined responses to questionnaire items involving 6 months, 1 year, and 4 years delays. Their data indicated lower discount rates the longer the time horizon, and the rate of decrease in the discount rate decreases with the time horizon. So the hypothesis for this theory is discount rates decrease with option duration, and the steepness of decline decreases with time. Exercise prices and option pricing. Both buyers and sellers call option decisions as risk-averse reflects concave preferences in the domain of gains. So the hypothesis is call option sellers and buyers discount exercise prices. The put option buyer seeking to insure against a loss and reduces the potential loss. And the hypothesis is put option sellers and buyers discount exercise prices. So next is the method they use in this research. They use the sample of voluntary responses from 64 part-time students enrolled in an MBA program at New York University. They use questionnaire for this research. The questionnaire consisted of 36 option valuation problems. Each of the questionnaire involved two possible outcomes, and they set the probabilities at 50%. And as the analysis for the hypothesis 1 until hypothesis 4, they use one-tailed test. The data from part 2 in the questionnaire computed the implicit discount rates for the periods ending at 6, 12, and 48 months. So the result of this research, we can see from the table 2. The table 2 shows a consistent premium when selling an option relative to buying the same options. So in general, the results indicate discounting of both calls and put relative to their expected values. So these findings support hypothesis 1 and until hypothesis 4. In particular, these findings suggest that markets for real option may fail to clear because asking prices consistently exceed bid prices even when buyers and sellers share the same understanding of the parameters relevant to valuing the options. Okay. From the table 4, we can see that mean values for the discount rate are positive for each of the three periods. The overall pattern exhibits the expected decline in discount rates as we move from proximates to more distant time periods. This is also consistent with hypothesis 5. The comparison in table 6 reports the mean differences in values for options without and with exercise prices. And the column PE in the comparison portion is the probability of exercising the option times the exercise prices. The expected change in option value. Call option buyers and sellers evidence shifts in option values that are less than the shifts in expected values. This is consistent with risk aversion, so the results are generally supportive of hypothesis 6 and 7. That are the results. Now we move on to the discussion about this result. These results indicate that considerations from behavioral decision theory are quite useful in analyzing the responses of individual option buyers and sellers. These results also supported the contention that call option transactions are framed in the domain of gains and reflect risk aversion. The results from introducing exercise prices also are consistent with prospect theory expectation as shown at the table 6 before. The result extend previous research on buy and selling price gaps to the realm of real option pricing, such as the buying selling price gap points out the difficulties associated with negotiating real option transactions. This gap may restrict the volume of real option trades and, in the extreme, may completely eliminate trading in certain options. The discovered price gap becomes inefficiency in real option markets, which provides strategic opportunities to capture the rent from unexploited trading opportunities. So the key to exploiting these opportunities is to reduce buyer and supplier biases, making new trading opportunities possible. But nothing is perfect. This research not discuss about everything. So there are several possibilities for extending this research for future research. Future research can vary the probabilities and determine the implication for perceived option values. And for the future researchers, could take up the issue of subjective estimates of probabilities. They also could take up the challenging problem of valuing compound options or option on options, which is a common type of investment problem managers face when making decisions about R&D and new ventures. Okay, thank you for your attention. That's all for my presentation today. Good day.